Okay, folks, so we've got three things to discuss. Number one, we got to talk about what the market is doing right now and the context for this historically. We are in a pretty aggressive uptrend on the year, and I need to show you some historical context, which explains what tends to happen when the first 100 days of the year are green. Number two, we got to give you an update on plays and the latest runners. PLTR, the lovely Palantir, made yet another cycle high today. WLDS, another cycle high today as well. Play after play is exploding. We need to discuss what comes next. And lastly, number three, for the main entree, I want to discuss what the heck is going on with ticker symbol AI for C3AI. Ticker symbol AI is one of the most popular stocks in the market right now and is about to release a key earnings tomorrow that they already teased will be a knockout. And regardless of what the stock price does tomorrow, I want to show you some data that suggests that we're heading on a week-by-week basis into a massive short squeeze on this stock. In fact, you're in the early stages of one, where shorts are just starting to cover pretty rapidly. Pretty obvious that if you did get a massive dump cycle on this stock, you're going to have a lot of shorts going and buying back shares, which would almost immediately cause a nice support level. I want to go through all the data that we have on this stock and explain exactly why it is running so aggressively and why, as it runs and breaks out more and more, it's going to make it more and more likely to squeeze even harder. We will get to work, and I will put all the timestamps down below. And today's video is brought to you by our Memorial 50 coupon code on ZipTrader U, which will get you 50% off our one-time fee for the program and will get you access to our step-by-step lessons, our private chat, and our very popular daily morning briefings. If you'd like to be up to date on all the biggest trade ideas and catalysts each and every market open morning, well, make sure to check out the program before the code expires at the end of this week. Okay, let's go in and get to work. So we are right now in another week with a very strong upward direction, and now on top of that, we have the debt ceiling talks having seemingly concluded amongst party leaders and are trying to work their way through Congress. If they pass, that will allow a lot more in terms of de-risking in this market. And today, folks, markets were a little bit flat, a little bit flatty McGee overall. However, in small caps, you've been seeing a lot more risk taking, and there's a lot more signs that suggest that the overall stock market might be heading higher as we head into the summer and into the end of the year, which is very contrary to a lot of the economic data that we've seen. You see, historically, the first 100 trading days of the year is very, very indicative of where markets will finish for the overall year. And Bloomberg found that a strong first 100 days results in an average annual performance of 25%, which is pretty damn high. And a strong start here is defined at about 8% or more in gains, of which we're at about 9.5% right now. So we're in this category where if you look at the historics, well, the average return is 25%. And if we're at about 9.5% now, that means that there's a lot more rallying that could happen as we head into the end of the year. You look at recent history, you had 2021 where the first 100 days returned 11.7% and the full year was 26.9%. You had 2019 where the first 100 days returned 12.7% and then the full year performance was 28.9%. You had 2013 where the first 100 days was 15.7% and the full year was 29.6%. And the only year where you had weak performance after a strong start to the year was 87, where the market had rallied 19.4% and then the full year was only 2% up. And 1987 was the year of Black Monday and the massive liquidity crisis around that time, and that was really the only exception to this rule over this long time horizon. And again, bigger picture, the S&P 500 averages 25% in the full year when it has a strong 100 first trading days. So from this standpoint, you're seeing a lot of funds go and say, hey, you know what? We're looking at history. Sure, the economy looks bad, but we're looking at history. And if you look at those first 100 days, if they're performing above 8%, well, tends to mean almost every single time, with the exception of 1987, that you're going to see a massive 20 to 25% gain. Again, is there backing from the economy on this? Absolutely not. This is purely a chart momentum play. The only argument that you can make from the fundamentals of the economy is that perhaps the Federal Reserve will facilitate this rally. As you know, the Fed has engineered quite the slowdown with its unprecedented hikes, but inflationary pressures are indeed falling off a cliff. You pull up the Truflation numbers, they are at about 2.87% now. 2.87%. Now remember, when you see this 2.87% number, that doesn't mean that prices aren't still extremely high. Of course they are. If you compare today's numbers to 2019, the inflation rate is ridiculous. We as Americans and people around the world really have been scammed by governments that have been printing too much money and employing policies that are quite frankly failures and just destroy the citizens. So I'm certainly not saying that we haven't been scammed, but what I am saying is that if you look at the numbers from the post-inflation prices at like 2022 and you compare 2022 to 2023, well, there hasn't been much inflationary inflationary pressures year over year. We've already been inflated like crazy and it sucks. We've been scammed, but 2022 to 2023, you haven't seen that much more in terms of inflationary pressures when you average everything out, about 2.87% up. The Fed isn't in the business of trying to erase the inflation that we had post-COVID. They're in the business of trying to make the year-over-year comps get to 2%. And quite frankly, because the Fed has destroyed the consumer, well, businesses haven't been able to raise costs that much, even though their input costs have been very, very high. And on a year-over-year basis, things are slowing down. Now, the last government reported rate was 4.9%, and so a trueflation rate of 2.87% probably means that the next government data for May is going to show inflation being at around 3%, which isn't that far away from the target at 2%. So that means from a market perspective, well, markets are increasingly expecting the Fed backstop, right? The Fed to come in and say, hey, we're going to pause. We're going to go ahead and increase liquidity. We're going to turn more and more dovish. Now, of course, the minute that the Fed turns dovish again, all of a sudden, all of this money is going to reflood into the system and inflation is going to start going up again. But markets are trying to play for a situation where inflation dumps and the Fed pivots. After that happens and the data starts showing inflation go up again, then markets are going to be like, okay, well, we got to sell because the Fed's going to go back up again. We've been talking for a while about how you shouldn't just expect inflation to drop down or go up. What you should do is expect inflation to go like this, up and down, up and down, up and down, which means that the Fed monetary policy is going to go up and down, up and down, up and down in the stock market, up and down, up and down, up and down, which means lots of opportunities for people who are trading the runs, but not a lot of opportunities for people that need to have it one way or the other. Everything's going to zero, everything's going to the moon. Those people, they tend to not be very happy most of the time because stocks go up and down, up and down, up and down. If you're just one way or the other, you're going to do bad. Obviously, if you have a very, very long-term time horizon, it'd be better to go long versus short. But at the same time, I mean, in the next couple of years, you're going to see some pretty devastating and some pretty exciting cycles. Okay, moving on to plays and runners. So PLTR up another 9% or so as I shot this video. PLTR is in this unique situation where it had gotten unduly beat down during the growth crash the last couple of years, but at the same time, of course, it is now in the middle of this massive, unprecedented AI hype euphoria wave, which is fantastiva, which is leading a lot of people who hated the stock at the $5, $6, $7, $8 range to pour into the stock, even though now it's at 13, 14, and even 15 bucks, right? And the idea here is that, hey, if many AI stocks that are actually real AI stocks are trading at many multiples, why shouldn't Palantir be as well? A lot of other stocks are trading at multiples that would put Palantir somewhere around 25 to 30, even $40. So a lot of people are looking at Palantir, they're looking at the recent earnings and saying, yeah, this is a pretty pure AI play. Well, let's go ahead and buy this up because there could be a lot more upside left. People are thinking this could go much farther. On top of that, a lot of the short sellers that forced this down originally are now jumping to the other side and riding the waves as well, creating this dynamic where shorts are buying the stock and causing the stock to go higher, and at the same time going and then buying more shares. And of course, on top of that, a lot of the media who spent the last 2 years of the crash saying that Palantir is a sell are now pumping out articles saying the exact opposite. Folks, you know that I love Palantir over the long term, but at the same time, I cannot sit here and tell you that, hey, this is running because Palantir is a good business. No, it's running because people want to buy AI stocks. So if you're somebody that wants to play this, I strongly recommend thinking to yourself, maybe, just maybe, I should play the moves, but not let the moves play me. Maybe I should play this as an AI hype stock that can get very frothy very quickly. I think it's going to get a lot more frothier than 15 bucks, by the way. I think in a couple weeks, you might see this hit 20, even higher. But at the same time, I have to acknowledge that, wait a second, when the AI hype cycle dips once again, this is probably going to go back down to 10, 8, 7, maybe even $5 again. So I would consider playing the move, enjoying the move, but not fooling yourself into thinking that this is just going to go to $100 without any massive pushback. WLDS, we originally briefed on at about 58 cents a share on the 25th, and as of this morning, it just hit another new cycle high at 225, which is a 287% run. Now, we originally briefed on it because of its excitement around the Mudra Apple band reaching the pre-order stage, and again, it's been pretty damn incredible. However, without any more news, I believe this is a bit of a ticking time bomb, and I'd argue it's almost done. Maybe, just maybe, you get another slightly higher high tomorrow or the next day, but I think this is overbought at this point, and the catalyst just doesn't seem to deserve another new high. It seems like it's already run a little bit too much on this catalyst, to be honest with you. I thought maybe it would get $100 300% run, but 287%, I think that's a little bit pushing it for this catalyst that's not even really a true Apple affiliation catalyst. It's just, oh, we're selling something for Apple customers that buy the Apple Watch. Like, that's not even that big of a deal. So I would say probably this is about dead. I would think that you want to start controlling your risk pretty aggressively on it. Okay, next I want to talk about ticker symbol AI for C3.ai. Now, AI has been a stock that has been a big stinking beneficiary of the artificial intelligence euphoria boom. From a chart perspective, it's certainly in the nosebleeds. It looks to be just begging for another one of those judo chops where the position gets halved. But here's the thing, where there is volatility, there is opportunity. And in the next week or so, you're likely to see not just a rapid dump cycle, but also a rapid rebound cycle that takes it to a new cycle high. This is not only a pure play AI stock, but also a short squeeze candidate in which shorts are trying to close out as fast as possible. You see, May 31st, tomorrow after close, is when the next earnings for this bad boy comes out. And this company, C3.ai, signaled back on May 15th that they are expecting to beat their revenue target and that they are seeing significantly increased business activity. That is what I like to hear. Now, will whatever they come out with on their earnings tomorrow justify business-wise this massive increase in share price? Of course not. This stock is already up some 264% year to date. But markets right now, they don't care about the fundamentals. All they care about is artificial intelligence and riding that juicy McJuicer trend. Markets are asking but one question right now. Is it a justified AI play, and can it capture some of the insane forward potential of AI? And ticker symbol AI, relevantly named, very convenient to have a ticker symbol of AI during an AI hype play, is one of the purest AI plays out there. And that is what markets are thinking right now. It's a big deal when you have a company that is not just adding AI to a press release to make their stock go boom, boom, but is actually a real pure AI play. Look at their clientele. They are working with the U.S. Air Force. They are working with Raytheon. They are working with Shell, Fidelity, Baker Hughes, Cargill, Con Edison, the Department of Defense, Missile Defense Agency, with the DoD, Kosh, and so on and so forth. So again, if you are a fund looking to play a stock that is actually an AI play, well, this is one of the purest out there. Not only that, but even after this massive, insane run, well, the stock is still trading at a market cap of just $4.5 billion. $4.5 billion may sound a lot given the fact that this was trading at like $2 billion not too long ago, but it is completely chump change compared to the overall AI trend. NVDA just last week jumped hundreds of billions of dollars on AI euphoria. Markets right now are willing to add hundreds of billions of dollars worth of market cap just for AI euphoria. Now, AI isn't going to get hundreds of billions of dollars like NVDA, but it certainly could get billions of dollars, if not tens of billions of dollars. Now, of course, I prefer to talk about stocks when they're in a dead cycle or are oversold, and well, this stock is in neither of those periods of time. But the reason this play is relevant is because it is indeed a short squeeze candidate, and the more that it runs, the more proof of concept that this has that it can squeeze further. If you see a dump cycle tomorrow on earnings or a few days after earnings, you're going to get a lot of shorts that are short this, using that as an opportunity to close out, aka buy back shares to cover their short. And what will that do? Well, that will provide support for the stock, which then the support could be a level to bounce off of to a newer high. You see, the thing here is that C3.ai was supposed to be a home run for short sellers. They threw the book at this, they built out huge, massive short positions, and they expected this to go down as close to zero as possible. Harrisdale, the most notable short seller short this, released a damning short report warning investors, of course warning because they're so nice to warn people, back in April about alleged accounting errors, and of course, as always, markets panicked first and asked questions later, and the stock price got cut in half, making so much money in unrealized gains to these short sellers that came out with this report. It's really a great business model. I highly recommend doing the short and distort campaigns because they just make so much money. And it's totally legal to do that too if you're a hedge fund, because hedge funds have really good rules and no one criticizes them because, oh, they're so smart, so smarty McSmarty. The problem though, well, C3.ai refuted the short sellers' claims, and short sellers net weren't smart enough to close out of their positions and lock in profits before the big rebound happened. And so now shorts are stuck short this at much higher prices than even previous peaks had this at. And yes, short sellers are starting to wake up, and you can see they've been trying very, very slowly to close out of this position. However, it's not working out too well because the stock is shooting up higher and higher. And if this can keep holding at these levels, especially higher than previous peaks when the short seller report first came out, well, you could easily see this break out to newer and newer highs as more and more shorts are forced to cover. So I like this stock from an AI hype euphoria standpoint, and I like it even more as a short squeeze candidate. I think that if you were going to have a strategy for the stock, the best way to look at it is, hey, I want to see this stock do a dumpito, something wild, but that doesn't derail the overall momentum. Something that causes markets to say, wow, AI, it's done. It's a falling knife. Sell, sell, sell. Shorts will then use that as an opportunity to start covering out of their short positions. And then that is when you start seeing the pickup to a newer and newer all-time high. For those of you who read the last email report, we said with ticker symbol AI that we do want a pullback, but just not past our long-term right directional SMA line. In English, we want a pullback, but we want it to continue its overall direction. We want it to continue going up overall, but we just simply want a pullback on that uptrend, right? Because that allows not just a test that allows for some proof of concept that says the stock isn't dead yet, but also allows for cheaper entry prices. And that kind of resilient momentum is what you want for a squeeze. And if you go over to the options chain, it seems pretty soon market makers may have to just start buying shares in order to hedge against the higher share price and print higher strike options and cover for or hedge for the options that they've already sold at much, much higher prices, which could cause a nice gamma squeeze. We'll see. Keep this on your radar. And I would say, again, look for a sell-off that holds overall momentum. And then if it does that, look for a rebound cycle because that could be quite juicy. And some would even say Juicy McJuicer, but that wouldn't be me saying that. No, never Charlie. Anyways, folks, that caps off today's video. Hope you found value in it. Make sure to take advantage of that Memorial Day Memorial 50 coupon code, which expires at the end of this week. You will get 50% off our program, and we can see you tomorrow morning in the daily morning briefings. I think we're going to have some exciting plays on there because the way that the market is heating up, it's heating up very aggressively right now. Well, it suggests that you're going to see a lot of runners coming soon. No promises. Obviously, we don't control the market, but I think you're going to see a lot of runners. Have a good one, folks. We'll see you in the next video.